So it's not a function of if, but when we're going to go through the next bear market. An investor who retires today with a 30-year time horizon will probably go through 5 or even 6 bear markets during their lifetime. So it's super important to understand their importance and also be prepared for the next one. But first, my name is Kevin Lau. I'm the host of the Planning for Retirement podcast, and I'm also the owner and financial planner at Imagine Financial Security. We help individuals over 50 who have at least $1 million saved maximize their retirement spending, minimize their lifetime tax bill, and worry less about the financial markets. If that describes you, make sure to subscribe to the podcast. We put out weekly retirement planning content specifically tailored to you, PFR Nation. So first, what is a bear market? All right, so a bear market, simply put, is when the market drops 20% from its previous high. Okay, so a 20% drop in the market is a bear market. Okay. Another term that's also thrown out there as well is a correction. Okay. So what is a correction? A correction is when the market drops by 10% or more from its previous high. Okay. And corrections are very common. In fact, we've had 27 corrections since World War II. In those corrections, eight times did that lead to an actual bear market. So about 30% of the time we had a correction, did we actually enter bear market territory? And again, I'm doing this episode not to go out there and sound the alarms and say, hey, we're going into a bear market, we're entering a recession. I just want you all to be prepared for this because it's a normal part of investing. If we had no volatility, if we had no risk, there would be zero return. And on this week's podcast episode, I talked about 14 ways to prepare your retirement plan for a bear market. So make sure to follow our show and make sure to check out that episode that we released this past Tuesday. And I'm going to also make sure to link that in the in this particular episode in the description. But at the end of the day, these corrections, these bear markets, regardless of what's going on or what's happened in the past, it always feels a little different. Okay. And I get that. This time is always different. And I hear that oftentimes from individuals that I work with or prospective clients that I talk to. It's just like, it's always like, hey, this time is different. But what I thought I'd do for this episode is let's kind of go through these. Let's go through these one-on-one or one by one. Let's actually talk about the bear markets that we've had since World War II. And let's ultimately see what the results were for equities, but also for bonds. And then we're going to hit on those 3 mistakes that typically investors make during those times of volatility, during those bear markets, so you can make sure you prepare and avoid them. And then again, make sure to check out our episode where I talked about 14 ways to prepare for the next bear market. All right. Before I get into these, obviously you're probably wondering who is this baby face on the screen here, on the video screen. Well, I officially shaved my beard last Sunday. I told my wife, I promised her that I would shave my beard before her birthday, which is this Sunday. So if you want to wish her a happy birthday, make sure to do that. Drop a comment, say happy birthday, Jessica. But anyways, I shaved my beard. It feels weird for sure. I don't even know what to say. I've had beard now for like 6 months, so I've gotten used to it, and I liked it. But you know what? It's kind of nice to go into the spring and the summertime ultimately with a clean face, right? And plus, my boys kept looking at the grays on my goatee, and one of my sons asked me, why is there icing on your face? I'm like, oh gosh, all right. Anyways. Okay, so the first one we're going to talk about is the pandemic, COVID-19. Now, we all remember this like it was yesterday. I don't know about you guys. I remember it was like yesterday. And it was wild because during that period of time, I had just come off of paternity leave, and I just got back into the office. So I had a few months out of the office when my first son was born, and then I was back into the office for like a month, and all of a sudden the pandemic hit, forced everyone to shut down, work from home. Many businesses shut down in general. Many businesses couldn't afford to pay payroll and had to temporarily lay people off. No one was going to restaurants. No one was shopping anywhere other than online. So it was a crazy time. And so inevitably we had a slowdown in the markets, a significant slowdown. Unemployment hit 14%, I think it was, or maybe it was 10%, during that period of time. But really from December of 2019 up until March of 2020. And actually, the bottom of the market happened on my wife's birthday in 2020, so March 23rd of 2020. But the market sold off at that point in time about minus 34%. Okay. And I'm telling you right now, people were so afraid of going into a significant recession or even more so a depression. I had literally people whose parents lived through the Great Depression, and it was very real to them. And they were they were convinced that we were going to enter a depression. And look, listen, I didn't have a crystal ball at that point in time. So who was I to say, no, we're not going to go into a depression? I had no idea. I'm thinking this is crazy. This is unprecedented. Okay. But I understand, my part of my job is to coach people through the ups and downs of the markets because things are emotional, especially as you approach retirement, especially as you enter into the beginning phase of retirement. There is a big risk of a downturn affecting the longevity of a retirement plan. So people are naturally more afraid of the market volatility as the closer you get to retirement. It's very easy for someone who's, let's say, 40, 45-year-old to say, oh, great, this is a buying opportunity. Well, not for someone who's 60 or 65. This is all they have. They're not adding more money to the portfolio. So, of course, it feels differently. But I remember, talking to people after the pandemic. Okay. So like, a year, 2 years down the road. And I remember the stories that people told me about moving out of the markets in March or in April, during the volatility of COVID, because there was so much uncertainty. Like it's better me just sitting on the sideline and waiting it out because, at least I'll cut my losses. Well, minus 34% sell off in the stock market during that period of time up until March of 2020. But then the markets actually turned positive and basically made everything back by May of 2020. And by the end of the year, it was the markets were positive 20%. But during that period of volatility, just some perspective on this one, during that period of volatility, bonds were positive. What did they do? They returned about 3.7%. So I'm just telling you right now, if you have a diversified portfolio of both stocks and bonds, you have a place to go. You have a place to hide during periods of volatility. And stocks, generally speaking, there's one instance, and if you know what I'm talking about, there's one instance where stocks and bonds both dropped in lockstep for a prolonged period of time. And that wasn't very pleasant for individuals that retired and had, let's say, a 60-40 balanced portfolio. But during the pandemic sell-off, stocks, during that period of time, it was bloody for stocks minus 34%, but bonds did return a positive yield of 3.7%. But ultimately, why I believe this rally happened was because of record stimulus that was pumped into the economy. And this goes to our first poll question here. Okay. So the question is, what was the total stimulus package that the U.S. issued between the CARES Act of 2020, which was signed into legislation by President Donald Trump at the time, and then the American Rescue Plan, which was signed into law by President Biden? The question is, what was the total stimulus package? Was it 800 billion, 500 billion, 1 trillion, or 4 trillion? I'm going to give you guys 7 seconds to answer. All right, that time's up. If you answered D, you were correct. $4 trillion of stimulus that was pumped into the economy. Truthfully, I'm going to just go off on a limb and say half of that was not needed. Half of that was to provide businesses who didn't need the funding with payroll support, these PPP loans, okay? And then part of it, half of the payments that went to individuals were to people that also didn't need it, okay? These were people that I know in my circle of friends that I know they're making multiple six figures and they don't need handouts from the government. Obviously, there was uncertainty and volatility in the markets, but at the end of the day, they were working from home. They were able to keep their multiple six-figure job and continue to work remotely. Why did they need stimulus check? And ultimately, I do believe, call me crazy on this one, I do believe this was a big factor in causing inflation in 2021, 2022, and the issues we're still having today. The stimulus is still being spent, okay? Some of the stimulus packages that were issued, the deadline was to issue these contracts or to sign contracts by the end of 2024 and then be spent by 2026. The money is still floating out in the economy. Why do you think inflation is a problem? Okay. Because there was just, they had to spend the money. The government was just giving these handouts out for free. So I just say this because I believe this was a big reason why the markets rallied in 2020 and 2021, because the expectations that we weren't going to go through a crisis because the government was out to save us. But now we're feeling the effects of this one with high inflation and with now higher interest rates. All right, I'm going to do a countdown on this one. So number 6, we've got the Cold War, which was much longer than this period of time, but Cold War and ultimately the Cuban Missile Crisis. I don't believe the Cuban Missile Crisis was really what prompted the sell-off, because actually the Cuban Missile Crisis happened towards the end of 1962. The sell-off for this particular bear market happened between 1961 and June of 1962. But the poll question that I threw out here was, who was the president during this Cuban Missile Crisis? I'll give you guys 7 seconds. And if you answered JFK, John F. Kennedy, you are correct. And by the way, there's 4 poll questions, so write down your answers on the side. Tell me how many you got right. Drop it in the comments. Did you get 100%, 75%, 50, 25%, or 0? But anyways, it didn't feel like there was one specific event that happened, but more so it was coming off the heels of a significant run up in the stock market post World War II. Okay, so really towards the end of World War II, the stock market rallied pretty significantly, and then that continued through the 1950s and into in the early 1960s. So I feel like prices were a little bit high. The market was maybe quote unquote a little bit overvalued, but ultimately, I think the fear of a potential nuclear war was just out there in the global markets. It was just a concern in general, and it's timely because we're sort of in the similar scenario with Russia right now. But ultimately, the Cuban Missile Crisis that happened in 1962 really was kind of this, like, the tipping point, I guess you could say, where we found out that the Russians were basically building and storing these missiles in Cuba, and essentially that was a big concern because Cuba is basically right on our doorstep of Florida. So, there was conflict there that was ultimately resolved. But there was definitely a fear of going into another world war. And ultimately, this is what kind of precipitated the sell-off in the markets. And by the end of the sell-off, stocks dropped by about 22%. Okay. So, a little bit less of a sell-off with the COVID pandemic, but ultimately it happened over a longer duration. It happened over a long period of time. The recovery didn't happen for a few years later. But what did bonds do during that same period of time? Well, bonds actually returned a positive 2.1%. Okay. So again, if you needed to hide somewhere, you could hide in the fixed income side because that was generating positive yields, positive returns. So if you had a $1 million portfolio that was, let's say, 60-40, your rate of return wasn't minus 22%. If you simplified it and said you owned U.S. stocks 60% and then U.S. bonds 40%, your return was minus 12%. Still painful, but not as painful as minus 22. Let's look at number 5, Russia and Ukraine and inflation. So this was really the Russian invasion of Ukraine and ultimately inflationary pressures. So really 2 of the things that we've just talked about. Okay, so geopolitical conflict and high inflation led to this particular sell-off in 2021 into 2022. Okay, and stocks ultimately ended up declining on this one by minus 28%, minus 28%, 28.5% for stocks. But on this one here, what did bonds do? Bonds actually went down by 15%. Okay. That was a tough one. 60-40 portfolio in 2022 was a bad time for a 60-40 portfolio, probably arguably ever in history. And, if you look at this one, if you owned longer term, intermediate to longer term bonds, so bonds that matured in, let's say, 10 years or longer, you got absolutely hammered. This is exactly why in 2021, early 2022, we shifted not all, but a majority of the fixed income into very, very short-term bonds because, yes, they had some price volatility, but then they were quickly maturing. And as those bonds matured, we were able to turn around and reinvest those at now higher yields because ultimately what happened was the reason why bonds sold off is because interest rates went up. And as interest rates go up, the value of your bonds go down because who's going to want to buy your bond for a lower coupon than they can buy with the same risk and the same duration as they can buy today. So that's why prices have an inverse correlation, bond prices have an inverse correlation to interest rates. Okay, but again, there was significant concern with inflation, significant concern with pandemic still, at the forefront. We were still in a pandemic, not in Florida where I live, but much of the country and much of the world was still being impacted by the pandemic and the supply chain issues. And yes, I believe the supply chain issues had a big impact in terms of inflation, but I do believe that stimulus was also a big part of that as well. Okay, but this one was a tough one because, again, stocks and bonds were both negative significantly during that period of time. Number 4, let's look at Black Monday. Black Monday, everybody. This was the single worst day in stock market history. And the next poll question that's popping up here on the board, the whiteboard is, How much did stocks lose? How much did stocks drop by on Black Monday? I'll give you 7 seconds. So if you answered B, you are a winner. Minus 22% on a single day. Now this one is a tough one because again I'm looking at ultimately what was going on in this period of time, and yes, we had some inflation popping. Inflation was on the rise. There was also 3 consecutive quarters of slowing GDP. So GDP was we had an economic slowdown, gradual slowdown. Inflation was starting to tick up, but I think really what caused a lot of this was there was this bubble brewing. We had the markets ran up 44% in the 7 months leading up to Black Monday. Okay. And then the week before Black Monday, the markets started to get rattled a little bit. The markets dropped about 9%. Okay. And again, I think it was the inflation prints. It was the GDP slowing down. But ultimately, I believe what happened was, there was a big concern, from what happened with the stock market in late 1960s, early 1970s with awful market performance. And so what happened was the creation of these portfolio hedging strategies. Portfolio insurance is what I would like to call that. And ultimately this involves trading options. Okay. So call options or put options, and essentially being able to take advantage of price volatility and protecting against some of the downturn. What happens though is when there is a downturn, a lot of these portfolio insurance strategies back in the day, and still today really, but back in the day, they were automated. So they were not manned by humans. So they triggered automatic transactions when the markets hit a certain threshold. So in this particular case, when the markets drop by a certain percentage, these portfolio insurance strategies auto sold. So there was just so much selling going on coming off the heels of that 9% decline going into the weekend. And then you had essentially we were in a global economy at that point. So you had institutional investors from overseas investing in the US stock market too. They began to sell off. Then the markets opened on Monday and the portfolio insurance strategies just went nuts. And there was so much selling going on, not enough buyers. And again, that led to a 22% drop in the stock market. But ultimately, if we look at bonds, during that period of time, so the stock's down 22. Okay. Bonds during that period of time, not just that particular day. I'm just talking about the whole sell-off, but bonds during that period of time, positive 5%. It probably shouldn't have been negative there. Positive 5% for bonds. So again, if you needed to hide somewhere, bonds were generating positive returns during that period of volatility. And what happened, on the heels of this one, well, the day after Black Monday, the Fed chair came out and said, hey, we're going to stimulate the economy. We're going to pump out money into the markets. We're going to create liquidity. We're going to shore up some of these portfolio hedging strategies and essentially bail out investors. And I believe this is what happened. This is sort of like a little sort of preview or precursor to what happened in 2008, 2009 with the Fed bailouts. And is there a moral hazard that is created by the Feds just coming out and stepping in and saying, hey, we'll save everyone. We'll save everyone from their mistakes, from their over optimism and the fear of missing out and just investing blindly into the stock market. I'm just saying on that one. All right, countdown to number 3. Inflationary decade. Okay, so the inflationary bear market, this one was between 1968, I'll put the dates up there. This was 1968 to 1970. So this is really the beginning of what we talked about with the worst case scenario of a retiree retiring in 1968. This is what we're talking about. Is this was the beginning of this hyperinflation decade where we had high inflation. Vietnam War was at the forefront, tightening monetary supply, and again, ultimately, sort of over-optimistic investors piling into the market at the very end of a bull run. Okay, so we had, sort of after the sell-off that happened in 1961, 1962 with the Cuban Missile Crisis, markets rallied pretty aggressively for several years. Okay, but what happened was, at the very end of that period of time, right before at the beginning of 1968, we had all these late investors just coming in, and all of a sudden they thought they were the next Warren Buffett. And essentially, in the 5 months leading up to the sell-off, Merrill Lynch opened up 200,000 new brokerage accounts, and so essentially stock investing became sort of the norm. Like the everyday individual was now investing in the stock market, and now 53% more people owned stocks at that period of time relative to 1965. So in a 3-year period during that bull run, there was a 53% increase in individuals that were investing in the stock market. That's a better way to put it. So you had this overly optimistic investors piling into the market, and now all of a sudden inflation started to tick up, because again, the markets are running hot, inflation's starting to go up, and now you start to tighten the monetary supply. Now that begins a sell-off. And so at the end of that sell-off, during this first bear market in this period of time, stocks returned minus 35%. But what did bonds do during that period of time? Let's look at bonds. The average return for bonds during that 3 years was about 5%. 5% on bonds. Okay, so again, if you needed a place to hide, fixed income, a great place to stay during that period of volatility. And if you did that, your rate of return was not minus 35%. Let's say you were 60-40, your rate of return was probably closer to about minus 19%. Still painful, but not as painful as minus 35%. All right, number 2 on our countdown here, we're getting close. Number 2 on our countdown is the same 10 years, within the same 10 years of the high inflationary period when it began. We had 1972 to 1974. We had what we call the 3 I's. We had inflation, so we had high inflation, high interest rates, and we also had the threat of impeachment, okay, with the Watergate scandal. Okay, so 1972 to 1974, the pain continued on this one. Okay, and at this point in time, the markets really sold off. And obviously those were the primary 3 concerns, but also I believe that the oil embargo was really what sold off the markets, because essentially the OPEC nations cut off cut off oil exports to the United States and some other Western nations because of our support for Israel during their war at that point in time, during the Yom Kippur War. And so ultimately, this led to a complete sell-off in the markets because of concern that inflation was going to run even hotter, which it did. Okay, but ultimately the stocks at that point in time during this sell-off reduced by about 59 point. I'm sorry, stocks went down 51.9%. What did bonds do at this point in time? Bonds actually didn't do awful. Okay, if you kind of compare this to the 2022 market that we just talked about, where bonds were down 15% as interest rates went up and inflation was high, bonds actually held pretty steady because some of the rate hikes were already behind us at that point in time. But bond returns went up about positive 2.83%. Okay, during that period of time. So if you had a diversified portfolio, you were able to stop the bleeding just a little bit on the fixed income side. This here is the bonds. Here's stocks. Okay, but there was some serious uncertainty, really these 2 periods, 1968 all the way through 1974, is really 6 years of blood. 2 significant bear markets. That's what I'm talking about. With someone retiring in 1968, or really truthfully 1966, they experienced 2 bear markets in their first decade of retirement. But still they were able to do the 4% rule. The 4% rule, they were able to preserve their assets for at least 33 years. And so, that's, in my opinion, sort of that worst case scenario, that perfect storm of retiring into the downturn. Okay. But, things recovered, things ultimately did recover. It took a little while, but things did get back on track eventually. And then we're going to go to number 1 now, which is what we call the lost decade. And the last poll question I'm going to throw out there is, when was the lost decade? And I'll give you 7 seconds. All right, if you answered A, 2000 to 2009, you are a winner. So again, drop a comment. How many did you get right? But listen, at the end of the day, the lost decade really comprised of 2 bear markets. So this one's like really packing a power punch. But I bring this together as one because this was the first period of time that the U.S. stock market was a negative rate of return over a 10-year period. Now, in the early 2000s, we had the dot-com bubble bursting, and then 2008, we had the financial crisis, which triggered the housing collapse and ultimately bank failures and bailouts and all that kind of stuff. Okay, but, bonds over this period of time, so stocks dropped, it depends on when you're looking at stocks, but really stocks dropped in excess of 50 plus percent, depending on what period of time you're looking at. So minus 50% overall. in both segments. So minus 50% in that bear market in the beginning of 2000s, and then in 2008, also minus 50% for stocks. But bonds did pretty well over time, during that period of time. They returned anywhere from 6% to 8% on bonds. It wasn't just yields, it was again prices going up because interest rates were going down as we entered a recession. And obviously, they need to stimulate the economy. And part of the way they do that is they cut interest rates. So if you had a 60-40 portfolio, you're able to sort of at least stop the bleeding just a little bit. We'll do this a plus there. But this one was really, really difficult because this period of time, this took 4 years to recover. After the Great Recession, it took really 4 years to recover. But what I'll throw out on this one is that if you had a diversified portfolio, so if you invested beyond US stocks, if you had international stocks, if you had small caps, you're actually, with a well-diversified 60-40 and then fixed income, you're actually able to generate a positive return of about positive 5% annualized. That's not terrible. During a period of time where stocks are selling off minus 50% during the first bear market, minus 50% in the second bear market, in that decade, if you had a well-diversified plan with international stocks and other equity pieces of the puzzle, you did actually okay. And so this is just a reminder for all of you that are sort of anti-international stocks, anti-small caps, just because of recency effect. You need to really rethink that. All right. So what are these top mistakes? And I think I could really hit on these top mistakes by simply using this chart. I love this chart. I don't know who to give credit for because I found this online, but there's a particular group of individuals that actually put the study out. If you know the answer, drop a comment on this one. But essentially, this is called the life cycle of investor emotions is the term that I hear. If you kind of look at this thing, you start off here, you're worried about the markets. Anytime you're investing, you're worried about the future, but you're okay. As things start to go up a little bit, you start to feel optimistic. And then as they continue to go up, you're feeling, oh, this is exciting. You feel the thrill of the investing, and then euphoria kicks in, and then you start to get complacent a little bit. You're like, this is the normal, right? This is the normal. I'm winning. I've been winning for a long time. I'm feeling complacent, but then the market starts to sell off a little bit. Okay. In the beginning, you're in denial. You're like, it's just a little bit of a blip in the radar, and then it continues to drop. You're like, okay, I'm optimistic. Things will recover eventually. Then you hit this point of fear. You're like, man, is this going to ever end? Is the bleeding ever going to stop? And then you're feeling panicked. You're like, man, I need to get out of here. And then capitulation, and then despondency. And then you're just indifferent. You're just like, whatever, this is awful. I can't do anything about it. All my money is, my portfolio is dropped by 20 to 30%. What am I going to do? Okay. Then the market starts to rally a little bit and you're feeling a little bit skeptical. You're then cautiously optimistic. And then you're kind of really back to this point at the very beginning, which is sort of, you're worried about the next drop. And this cycle continues forever, okay, with individuals, unless you can really truly understand that this is what drives market performance, okay? This is exactly what happens. When typically, fundamentals are let's say the average rate of return is here, okay? So fundamentals are solid here. But what happens is the markets aren't rational. The markets are irrational because you're dealing with people. You're dealing with people that are investing based on their emotions. And when things start to go up a little bit, the buzz starts to catch on and the media piles on, then people start to just late investors. Like I mentioned that period of time in 1968 when 53% increase of individuals that own stocks relative to the 3 years prior. This is when that happens, right up here. People get too overly optimistic and they don't realize this is mistake number one, that this is the maximum point of financial risk right here. You don't know exactly when it's happening, but you can kind of get a feel for when it's starting to happen. And instead of thinking that, hey, the markets have performed so well over the last couple of years, it'll continue to do that, complacency, okay? Don't be complacent. Be disciplined, be unemotional in your process, and have a process. Have a target investment allocation that you're investing to. If you have a target asset allocation you're investing to, you'll understand that, hey, now you're taking on too much risk because the market's moved your portfolio in one direction. The second mistake I see investors make is right here. They don't recognize that this is the point of maximum financial opportunity, okay? Not the maximum financial risk. When there's blood in the water, that's when there's opportunity to buy. Goes back to the Warren Buffett quote that I love to talk about. Be fearful when others are greedy, and be greedy when others are fearful. This is when people are fearful. Okay? Most people are feeling afraid. They don't want to invest. Hey, I'm going to wait to get into the market. Not realizing, hey, regardless of this is the true bottom, you don't know that. You don't know when the bottom is going to be. So regardless of when the bottom is, you can have a pretty good sense that somewhere along these lines here, underneath the historical averages, so we're underneath this historical average line, okay? Somewhere in this area, there's some buying opportunity, okay? So if we can take that same concept of taking risk off the table over here that we talked about, let's use that same concept and add risk to the portfolio when things are really bad. So the second mistake is people are acting on emotion and they want to bail when they're getting fearful. They want to get out of stocks. They want to move to more safer investments instead of kind of looking at it as an opportunity and say, this is the potentially a way for me to build lifetime wealth, solidify my retirement for the future, is taking advantage of other people acting on emotion. So that's number three. So that's number two. And then number three I'll throw in there, it's not on this page, is this quote here. This time is different. I hear this every single time. Anytime there's a sell-off, whatever the scenario is, it's always this time is different. When we went through this in 2022, it was this time is different. We're going to go through another hyperinflationary period that we're never going to get out of. Or hey, in 2020, we're going to enter into depression. Or in 2009, the whole global economy is collapsing. We're never going to get out of this. Or 2000, 2001, the tech bubble bursts. Our hopes are all gone. The dot-com movement is over. Internet is done. Okay, technology is done. And you can go on and on and on. And looking at periods of time in history when the stock market did what it did, entered a bear market, entered a recession, or hit a correction, people always think this time is different, but it's not. It is the same story. Again, looking at the cycle of investors' emotions, it's the same exact story. Bubbles happen and then they burst. Okay, so just know that, hey, wherever we are in the cycle, know that it is a cycle. And as things are going up, so over the last couple of years, so 2023, 2024, people were feeling, pretty optimistic. They were feeling the thrill. They were feeling the euphoria. And then all of a sudden, things started to get a little uncertain. Potential tariffs. Inflation is still a concern. Is the Fed going to continue to cut interest rates or not? And then markets started to get a little volatile. And now I'm starting to see people right here. They're starting to get fearful, and I don't know if they're panicking just yet, but I think if we hit a bear market, if we enter a recession, I could see this happening very, very soon. Okay. And then ultimately what's going to happen is it's going to create buying opportunities. So be ready for those. And this is part of what I talked about on the podcast, 14 ways to prepare your retirement plan for the next bear market. Because again, it's not a function of if, it's a function of when. And the tough part about all this is sometimes the cycle doesn't move as fluidly like it is on this particular chart. Sometimes what happens is you can kind of get here and then right here, and then it sort of reverts its course back here. And you don't know exactly when you're going to hit market bottom or going to hit market top. Like I said, out of the 27 corrections, 8 of them led to a bear market. So right now we're correction territory. Are we going to enter a bear market or not? Because sometimes if you try to move your portfolio in advance, trying to predict the future, you're going to get into the trap of trying to time the market. And the issue with timing the market is you need to figure out when to get out, but then you need to figure out when to get back in. And if you're wrong on the bear market and then all of a sudden the markets rally, let's say inflation starts to get under control, let's say the Feds continue to cut interest rates and all of a sudden the market shoots up, maybe some of the geopolitical concerns start to wane, all of a sudden the market shoots up, now you're caught on the sideline and you're like, what should I do? That's why you don't want to act on emotion. You have a disciplined process, and as the market moves your portfolio up, you take risk off the table. Right here. As the markets move down, you add risk to the table. You add risk on the table. You add money on the equity pieces because that's has the most opportunity for growth. And then don't think that this time is different. Know that yes, it looks a little different. The movie, the script looks a little different, but it's the same type of scenario. We have booms, we have busts. It's a natural cycle of investing. And if you're not comfortable with that, don't invest 100% of your portfolio in stocks. This is why we develop a dedicated investment strategy for every single portfolio that our clients have in their balance sheet. their brokerage account, their traditional IRA, their Roth account, their HSA, because each of those accounts have a different time horizon. So an account that our clients are going to tap into early on in retirement is probably going to look a little bit more defensive, a little bit more conservative than an account that they may never tap into. That's maybe for 100% legacy. Maybe it's the Roth account. So that one's 100% in stocks. So this bucketing strategy can sort of eliminate some of the noise that you might feel and sort of this kind of this reason to feel fear, because hey, I've got some income for the next 5 years. I've got that locked in on bonds. I've got this locked in on the fixed income side. I don't need to worry about what stocks are doing. So having a plan, having a process and sticking to that plan, and then knowing, yes, the movie script is a little differently. Maybe the cast of characters are a little different, but ultimately it's the same result. Have that in mind, and you're gonna be able to weather the storm, whether we go through a correction, bear market, or recession. Again, it's easier said than done, but having a process and a plan will set you up for success. And like I said, make sure to check out the podcast episode we put out this past week, 14 ways to prepare for the next bear market. And if you like this video, of course, make sure to like it and make sure to share it with a friend or family member that's approaching retirement or recently retired. That's what we call that PFR Nation type of caliber individual. We trust they will find value in our content as well. And of course, make sure to subscribe to our channel if this is you, if this is something that you are finding value in. But until next week, this is Kevin Law signing off.